All right, so from a housekeeping standpoint, I posted two videos. A company called UHY, they're an accounting firm. Anyone familiar with UHY? Let's look at it real quick. They're more of a regional firm. Here. Oops. Let's see here. Yeah. Anyways, it's a great company, accounting firm. They like to try to hire Truman students. So anyway, they made some videos for us. Just some of their employees made short videos on different topics. So I posted one on bank reconciliations that I thought was good. You can just kind of check out and kind of get his perspective on it. And then I posted another one that is just on the accounting profession and like his viewpoint on that. And so they're in the YouTube channel for this class. The links to get to them are in Blackboard under the most recent chapter. So check them out. I'll ask you about them maybe on Wednesday and see what you thought. If you felt like they were good videos, if you'd like them to do more, or on any different topics or anything like that. Okay. Just a reminder, we are adding in an extra chapter for this test, right? We're going to add in chapter 9. And so the exam is going to be moved back some. It won't be this week. Arctic Blast is still due its original time, so please be working on it. Get it done early so that then you can focus more on this, the next test. Okay. Any other concerns or questions? Go ahead. Yeah, exactly. The original, unoriginal time. Yeah, the time that it's the time that's listed in Blackboard, it's still due to. Go ahead, Kat. I don't think I gave you guys a specific day, right, for the next test. I just said we were going to have more time. So let's see how today goes, and then on Wednesday I'll have it figured out. Yeah, it will be. Which again, we'll see how we do on this test or on this material, and then I'll go and adjust my lab accounting after class and figure out what we do. Good. Other questions? Go ahead. Do you have a preference? Not Monday? Yeah, I can do that. Definitely won't be Monday. Good. Any other preferences? Go ahead. Okay, cool. I'm good with that. Not Wednesday. Any other preferences? One day? Not Friday? I'll have to look at that. We'll see how things go. I think Monday and Wednesday are good. We can take those off the table. Friday is let's say slim chance, but a possibility still. Okay? Is that all right? I was asking earlier, like, what can I do to make your guys' lives better? No one had a response then. So, I mean, beggars can't be choosers, right? Okay, that's that. All right, so let's look at this one. Number 7, I think, is where we were at on this. If you don't have this sheet of paper, it's in Blackboard, or you can swing by my office and grab one. Okay. It's called exam 4 review. Okay, so let's look at number 7. Maple Corp had net sales. Wait, oh, never mind. So this asset turnover ratio, we haven't done that ratio yet, right? That'll be in this chapter, the current chapter that we're going to start today. So let's not worry about that one. And then number 8, a company invested in a 90-day 6% note costing $8,000 on December 1st, 2019. Prepare the necessary. Oh, interesting. This really isn't this chapter either. Because if we're investing in a note, then that means that we have extra money, or is it? It is this material. Never mind. Is that right? Let me go check. So that's chapter 8. Yeah, it was receivables and it had note receivables in it, huh? Yeah, okay. Never mind. I'm off a little. Okay. So yeah, remember that's the idea behind this, right? We have extra cash. We don't want it to just sit there, so we loan it to someone. That's what we're doing, right? And so prepare all necessary journal entries to account for the investment, year-end adjusting entry, and receipt of payment, okay? So let me just close this real quick. So what did we start out with? What is going down? What is going up? If we have extra money and we loan it to someone else, then what must be going down? Cash? Is that what you said? Yeah, cash, right? Like I have cash. I don't need it right this second. And so I loan it to someone else, right? So my cash goes down. So we need a credit for cash, right? What do we need to debit? What's that? Well, remember, good job, but interest revenue, remember it like time has to go by before we record that. So what? You got it. You've got it. Note. Ooh, do we have to pay it or do they have to pay it? Notes receivable. Beautiful. Good job. And honestly, use that same logic, okay? So think to yourself, okay, what are we giving up? We're giving up cash. Okay. What needs to increase? Notes payable? No, we don't have to pay it. Interest receivable? No, no time has went by. So we can't do interest receivable or interest revenue. Okay. But we do, we're receiving a note in return. So note receivable. You good with that logic? Does that logic make sense? Can you keep those straight? The big one is remember that no time has went by, so we can't record revenue. And also, we don't have to pay the money. They have to pay us. So it's a receivable. Good with that? Okay, sweet. So note receivable. I'll abbreviate it. Okay, so that's our initial journal entry, and it's $8,000. Okay, good. Now, time goes by, right? So when was this? This was December 1st. So now we get to December 31st. Now what do we need to record? Good. What's that? Interest. Beautiful. So how do we record interest? Yeah, interest revenue, right? We've now earned revenue. So we want to say interest revenue. Remember, revenue is a normal credit balance. So we're going to say interest. Okay, so that's our credit. What is our debit? Are we receiving cash at December 31st? We're not, because look, it's a 90-day note. Okay, so we've got to wait 90 days until we actually get the money back plus interest. So at December 31st, have we received any cash? We have not, and so we just need to record a receivable. So we're going to call it interest receivable. Okay, so interest revenue, interest receivable. How do we do the calculation? Let me pull up the calculator here. So how do we do the calculation for the interest that we've earned during this period of time? 6%, what does that represent? That's the yearly interest rate, okay? But how much time has actually went by? What's that? Only 1 month, right? From December 1st to December 31st, okay? So we need to convert this thing into a yearly rate. So we're gonna go 0.06 divided by 12. So we're at 0.005 for 1 month, okay? Then we multiply that by the principal, which is $8,000, and we get $40. So that's what we've earned. They haven't paid it to us yet, but that's what we've earned. Okay, concerns with that? Anyone? No. It's not going to be perfect. 40. Okay. You like that? Is it making sense? It is? Okay, good. All right. So that's when we made the investment. This was our adjusting entry, right, at the end of the year. And then receipt of payment. Okay, so now they're going to pay us. What are we going to receive? Cash. Good. Are we going to have receivables anymore? We're not, right? So we need to get rid of those. Oops. So let's go. I'm just going to jump down a line. We're going to say that we get rid of the note receivable and we get rid of the interest receivable. Does that make sense? Because they're paying us now, right? So we've got to get rid of those receivables. Okay. What else has happened though in January and February? Go ahead. Yeah, exactly. We've earned more interest, right? So we actually, the other thing we need to record is interest revenue. Good job. Cool. So we're going to receive cash. We're going to reduce down the note receivable, reduce down the interest receivable, and then record interest revenue. So that's really it. So I didn't need a line here, did I? Okay. So I just have 1 debit and 3 credits. All right. So let's see. What do we know? We know that the note receivable was originally for $8,000, right? So we can get rid of that by doing a credit to it. The interest receivable was $40, so we can get rid of that by doing a credit. All right. Interest revenue, we don't know yet. So let's go ahead and do that calculation. Okay. So now we're going to go 0.06 divided by 12 to get a monthly rate. And we're going to multiply that by 2 months, right? January, February, so 2 months. And then we're going to multiply that by the principal, which is 8,000. So our revenue, which really we should have known that, huh? Because we knew it was $40 for 1 month And so it would be $80 for 2 months. So we probably could have done that in our heads, but that's all right, right? So we're going to go 80 there. And then for our cash, that's the total amount we're going to receive. Really, we could just sum those up, right? So we're at, what are we at? 9,000, no, 8,120. Good math? Yeah, sweet. Okay, does that work? The other way we can get that full amount is we can go 6% divided by 12 times 3, because it's a 90-day note, so 3-month note. Okay, multiply that by the principal, 8,000. Whoops, not 8. We get 120. Okay, and then we know the principal was 8,000. Go ahead. Yeah, yeah, it's fine to do it that way. Good. Other questions? Go ahead. You can, yeah. Yeah, you can do that. Normally, though, it's going to be by month, okay? And so, even though this is in days, I don't know. You just assume that that's a 3-month note. It doesn't make sense exactly, huh? Because it's actually, that's more than 90 days. But it's just, I don't know. That's an interesting thing. Normally, they will actually say that it's a 90-day note, but everyone just assumes that that's 3 months. Interesting, huh? So they don't normally say a 3-month note, but they do say 1 month note normally, which is interesting. They don't say
90 days.
Yeah, that's true. Yeah, 90-day trial or something. Yeah, it's interesting. I mean, on your test, you wouldn't get it wrong. Be careful on my lab accounting. They do another thing, I think, in this textbook that's kind of screwy, is they don't do 365 days. They do 360 days to make the math easier. But we all use calculators anyway, so it's kind of dumb. I'll double check that on the homework and make sure you're not getting messed up. But this is how it's done in practice in industry. I'll double check what my lab accounting does or whatever I want you to do. Okay. Good. Any other questions with this? Do these make sense? This is when we purchase the note. This is the adjusting entry for the note, and this is the maturity date. Okay. So it's also important that you know those words, or you know those concepts. Okay. Cool. We're the investor here, right? We're not the issuer. The issuer is the one that's borrowing the money. Okay, we're loaning the money, so we're the investor. Okay? This is the adjusting entry. That's always done at the end of the year. And then this is the maturity date. Normally what that's related to. Okay, good. Anything else? Sweet. Let's go now to the next chapter. Okay, this is a good chapter. We're talking about fixed assets that generate revenue, okay, that are used in like the day-to-day operations. Okay, so a fixed asset is an asset that's going to exist for a long time. Okay, so the kind of main categories are property, plant, and equipment. I guess that's not what I have up here. But that's the main categories, okay? Property, which would be, the building lot or whatever, the land. Plant is the actual building. And then equipment is the equipment inside of the building that makes whatever it is that we're making to sell. Okay? So plant assets, natural resources, that is, that's dealing more with mineral extraction or oil and gas extraction, stuff like that. So we'll talk a little bit about mining stuff. Intangibles are kind of fascinating. That's really what most of the value of companies nowadays is, because we don't have as many manufacturing companies here in the United States as we used to. We don't have as many like mines and stuff like that, but we do have a lot of technology-based companies. Okay, so intangible is, normally there is some type of property right associated with it. So whether it's intellectual property, which includes like copyrights, patents, trademarks, things like that. But sometimes there isn't like distinguished property rights. They may just be trade secrets, things that we have that make whatever we're doing special, that we just have kind of kept as a secret. Those are tough though, right? Because your competitors are always trying to figure out your secrets. They're trying to do what you're doing and then even do it better, right? So intangibles are pretty fascinating. I would say accounting isn't as up to speed on intangibles as really we should be. Okay, I mean, so much of our economy has shifted to intangibles, and some of the accounting for intangibles is still a little bit outdated. Okay, a little bit behind. So just be aware of that. Okay. All right. So what we call a capital expenditure. So we're spending money, we're spending capital, but instead of reducing down or recording some type of expense, we're actually increasing an asset. Okay? So we actually debit the asset. Like when we buy a building, we debit the asset. When we buy land, we debit the land. Okay? We don't record an expense. So that's important to know. We can also increase the life of the asset or increase its efficiency or effectiveness. And when we do that, we debit the asset also. Okay? So, if we're creating auto parts, we have a whole bunch of machinery that builds things, okay? And we go in and we update that machinery. We make it so it runs more quickly, or it doesn't make as many errors, like it doesn't mess things up as often. We're going to record that as an asset, like increase the value of that asset instead of recording it as an expense. Okay. This book calls it revenue expenditures. I don't love that. I don't see that a lot. But the idea is, if it doesn't increase the efficiency, if it doesn't increase the longevity of the asset, then we just record it as an expense. Okay? So let's think. An example of that. If we came in this room and we just painted the walls, okay, we would just record that as an expense. So instead of debiting the asset, which the asset would be this building, right? Instead, we would debit an expense. We would record it as maintenance expense or painting expense or something like that. See the difference? It's actually a huge difference. I don't know if people realize that. So one, we're recording it as an asset, right? Which you think of that as a good thing, that goes on our balance sheet. The other you think of as a bad thing, right? It goes on our income statement and it actually reduces down our profitability, right? So this does make a difference. Obviously, companies want to record things more as assets and record fewer expenses, right? So there are rules associated with that. Does it make sense why we would record painting the walls as an expense and not as an asset? Does that make sense or not so much? The reasoning is it doesn't really increase the usefulness of the room, right? It doesn't increase like how long the room will last. It doesn't increase the efficiency of the room, really. It makes it look better. But that's it, right? So it would be an expense. Okay? You guys agree or disagree with me? It's okay to disagree. So that's an example. All right. So plant assets, okay? So think of that as the buildings, right? The buildings. These are long-lived. They're tangible. We use them in the operations of the business, okay? Really, plant assets, I think of this more as like the buildings, okay? Here it's saying that they can also be referred to as property, plant, and equipment, or fixed assets. Okay? Some of this stuff is used interchangeably, but I don't know. I think the overall category is, I would say it's this way. I'd say capital assets, that's an umbrella term, okay? Within capital assets, you have property, plant, and equipment. And property refers to the actual land, plant refers to the building, and equipment refers to it. So that's the way I would categorize it. That's my experience with it, okay? So all different types of things fit into these long-lived assets. Okay? Furniture, equipment, automobiles, that stuff. Okay? We've talked about the cost principle. That means we record it on our books at its actual cost. Okay? Not at its appraised value, not at what we think it should be worth, or anything like that. We just record it at what we paid for it. Okay? We do include in though any kind of costs associated with making that asset usable, okay? Or like putting that asset into production, okay? So if we're buying some really big machine, we would include in the cost of the machine, the cost to get it to our building, to wire it up, to have someone come in and test it, make sure it was working. All of those things would be debited to the asset. They would increase the cost of the asset. Okay? That includes other things too. So like here, this was one semester I used the example of a taco truck. Okay, so if we ordered a taco truck, we had to special order it. It came in, and then we did like a vehicle wrap, tinted the windows, all of those things, like in the initial purchase, all of those would be debited to the cost of the truck. Okay, it's all required to get the truck ready for use. Okay. Which is interesting. So I guess that begs the question then, like, okay, why did we expense the painting of this room and we didn't expense the vehicle wrap or the painting of the vehicle? Go ahead.
Vehicle wrap would cause you to have higher sales. Are you
Yeah, I agree. It's like the advertising on um, the taco truck, so it'd help you have higher sales. I agree. Yeah, the other thing is with this room, yes, my logic was the room is already painted. It's been here. I don't know how long this building has been here, but it's been here for a really long time. Okay, and so for us to come in and paint it really just changes the look of the room, but it doesn't change how long the room is going to last. Okay, but initially when they built the building and they painted the room, that was included in the cost of the building. So originally it was debited to the asset. Now in future years, it's recorded as an expense. Go ahead.
So if we wrapped it like in a year after buying it, would that be an expense or not?
I think though, when it comes to a business, when it comes to a company doing the wrap, I think you can still get away with recording it as an asset. It's interesting though, because advertising, you can't record advertising as an expense or as an asset. Okay, so when I pay like the radio station to run ads, I have to record that as expenses. Okay, but with a vehicle wrap, yeah, I think that is increasing, like you said originally, like that's increasing our ability to get sales into the future. So yeah, I would think, and what we call that is capitalizing it, okay? Or recording it as an asset, capitalize the expense. Okay, question on it? Does it make sense what we're talking about? Yeah? Okay, cool. All right. We have this concept of lump sum purchases. I don't know, this is really kind of more of a theoretical thing on how it works. But the logic is this: we want to look at the fair values of every asset and then create a proportion and multiply it by the actual cost that we paid. Okay? So in this example here, we have land and a building. We paid $90,000. Okay? But the fair values of the individual land and building are different. Okay, so we had the land appraised for 30,000, the building appraised for 70,000. Okay, so to get our proportions, we're saying the land makes up 30%, the building makes up 70%, and so then we multiply 30% times 90,000, and that's what we'll record the land as, and then we'll do 70% times the 90,000, and that will be what the building is. Does that make sense? So we base our proportions off of the fair values. That's how we get the proportions, and then we multiply that by the actual amount we paid. Okay? So be careful. Don't do 30,000 of 90,000 to get your proportion, right? Do 30,000 of the combined fair value to get your proportion. Okay, the reason I say this is a little hokey is because ultimately the fair value is what we paid, right? It doesn't really matter what something appraised for. All that matters is what someone was willing to pay for it. And so I feel like this is just a little bit goofy, but it's just kind of teaching a concept. It's a concept that's important, is that we want to allocate the cost proportionally between assets. Okay? Does that make sense? Let's do another one, okay? So let me jump down here. We'll just make up another one real quick. Okay, let me just do another one here in sheet 2. So just say basket purchase. That's what these are called, basket purchases. Okay, basket purchase. So let's think about this. So let's say we have land, building, parking lot, and let's actually say like trail system. Okay, so imagine we're buying a new corporate office, okay, and it's pretty sweet, right? It's got a building, it's got land, but it's also got kind of a trail system for our employees to go walk on or whatever. So, okay, and then we're just going to say this is in. Let's just say this is in millions. Okay, so the land is, let's say 10 million. The building is, I don't know, 12 million. The parking lot is $1 million. And the trail system is 5 million. Okay, I'm just making it up, right? Okay, so that's their individual fair values. Okay, so now we need to do the proportion that each of those make up. Okay, so we're just going to say sum. So the total fair value is 28 million. So let's just go. Okay. So let's look what we have here. Okay, so the land makes up 36% of the purchase price. The building makes up 43%. The parking lot makes up 4%. And the trail system makes up 18%. Okay, does that make sense? What we did there? Okay. And so and then let's just say that we paid $25 million. Okay. So when we go to do, so we paid $25 million. Okay, so when we go to do our journal entry, we want to record all four of these things as debits, right? But now we're going to use the proportions. We're going to go 36%, and we're going to multiply it by the total amount we paid. Okay? Let me log in this. Okay? And then our cash, let's just say we paid cash. We have tons of money, right? So we paid cash of 25 million. Okay? Does that make sense what we're doing? So instead of recording the land at $10 million, we wanted to record the rule says that we have to record it at its proportion, okay, based on the fair value. So we need to record it at 36%, not at $10 million, okay? And then the building is at 43%, the parking lot is at 4%, and the trail system is at 18%. Basket purchases, do they make sense? Okay. You might ask the question, well, if that's really the fair values, then why didn't we have to pay $28 million? And I don't have an answer, honestly. That's why I think it's a little hokey. You know, if that's really the fair value of each thing, then that's what we should have paid is $28 million. It's not how they do these problems. Okay. Questions on it? I don't know. Any of your parents in real estate? Do you have a reason why the fair value would be 28 million and the amount we actually paid was 25? What's up? Okay, yeah, so we got a deal. But even then, I would say, then that's what the fair value must be, right? Like if no one was willing to pay 28 million for it, right? Like if someone was willing to pay 28 million for it, then that's what the person would have sold it for, right? They wouldn't have taken 25 if they could have got 28, right? This is supposed to be the fair value is what they call things. The fair value of the individual assets. Exactly. And that, for me, the only one that really decides the fair value is the person that's willing to pay it. I don't care what the appraiser says. You know, that's my, I understand what you're saying too. Like, oh, this could be a deal, and that's why we got it for 25. But then I would say, okay, then that must be the fair value. No, that is kind of what they are. To 25, yeah. So why didn't we then change these prices too? It's kind of, it should, I mean, this is just the rule. So know that, I mean, accounting, it really is, I mean, it's just created by humans, and there's a push and a pull process to everything, right? Like managers want to report things certain ways, and regulators want to report things other ways, and so there's always this tension, and things are changing constantly. So it's not perfect for sure. Cool. Question? Everyone understand how to do it? No? Makes sense, the logic? All right. Okay. Question? Did someone say something? No? Okay, depreciation. So the logic with depreciation is, now we've recorded that asset, right, at its cost, and we didn't record any kind of expense, right? We debited the actual asset, okay? Well, now what we're going to do is we're going to say, okay, what is the useful life of this asset? How long do we expect to be able to use it? And at the end of the time, like when we get done using it, will it be worth any money? Okay? And if it is, we call that the residual value. Okay? If it's worth any money at the end, then we call that the residual value. And then we simply divide the cost of the asset over its useful life. Its useful life minus the residual value. Okay? Don't necessarily think of depreciation as, I don't know, reducing the value of the asset. Okay? It really is, it's more based on just spreading out the cost of the asset over its useful life. Okay? Because it's one of those things like, just because we chose to depreciate it a certain way doesn't mean that that really is the value of the asset. Okay? Sometimes they aren't, like, reality is not connected with what we're doing. Okay? And it doesn't have to be. Honestly, companies can choose what method they want to use, and as long as they stick with it, it's fine. Okay? Residual value, oops. Another word for that is salvage value. Okay? Just means like the amount that we think we could sell it for at some point. Okay? After we're done using it. Okay? This useful life, if we do make changes to it, we handle those changes moving forward. Okay? So we don't go back in time and change our depreciation expense. Instead, we just change it moving forward. Okay? So, everyone okay with that? You get the idea behind what I'm talking about? We have the cost, we divide the cost over its useful life. That's really it. Okay? One way we can do that is just in a straight line. Okay, so a straight line means that we're going to record the same depreciation expense every year, all the way up until we're done, until we're at the end of its useful life. Okay, so this is the easiest method, and it makes sense. So we start out with what's called the depreciable base, which is simply the cost minus the salvage value, or the cost minus the residual value. Salvage value, residual value, those are used synonymously. Okay. All right, so once we have that, then we just divide it by its useful life. Okay. And that'll give us our depreciation expense each year. Okay, for each period. So if we look at this, we have an asset that cost $11,000 and has a salvage value of $1,000 and an estimated useful life of 5 years. Okay, so we go 11,000 minus the salvage value. That gives us our depreciable base. And then we divide it by 5 years to get our depreciation expense each year. Okay. That's the straight line method. There are kind of tricky things with this on when to start, if there are ever errors, partial year, carrying amount, and disposal. Okay, so let's go ahead and look at, let's go to Google Sheets again. Move back over here. Okay, and did I delete? I must have. Just move this down. Okay, so the first thing, when to start. Okay, so the rules on when to start are pretty straightforward. It's when we actually put the asset into service. So it's when we start to use the asset. So think of our taco truck. Okay, we don't want to start depreciating it when we first get the truck, because remember, we still needed to do the window tinting, we still needed to put the wrap on it, we still needed to load it up with supplies, right? And so we actually start recording depreciation expense when we actually start to use the truck to sell tacos. Does that make sense? So that's our when to start. Errors, okay? So let's just say we made an error. We only thought the truck was going to last 10 years, okay? But then when we got into year 8, we realized, hey, you know, this truck is really well built. It's going to last another, I don't know, 5 years or something like that, okay? So we don't go back in time. We don't go back to our financial statements from the previous years and change the depreciation expense. Instead, all we do is change it going forward, okay? So let's do that. So let's pretend, I don't know, how much do you think we're into our taco truck? What? $100,000 with everything? I think it's good. Okay. So 100,000 bucks. Okay. And what do we think our useful life would be? Should we just say 10 years? Okay. Do we want to have a salvage value? Anyone? We're just making this stuff up, right? But $10,000 salvage value? Okay. Oops. Okay, so salvage value 10,000. All right, so you guys calculate, what is the depreciable base? What is it? Who said that? I think you had it right. What is it? The depreciable base. Remember what the depreciable base was? It's just the cost minus the salvage value, exactly. So it's 90,000. Okay, everyone good with that? So we'll just abbreviate. Depreciable base is 100,000 minus the 10,000, so 90,000. Okay, what is our depreciation per year? Our depreciation expense. Good. So depreciation expense will be the 90,000 divided by 10 years, right? Okay. So that's our. Yes, it did. Doesn't let you drag things into the sheets like you can. Okay, everyone got it? So $9,000 every year. Okay. Well, then what did I say? After 8 years, are we almost out of time? We're in 10? We're good. What time do we get out of this class? 12:20. We're out of time now. Okay, that's fine. We'll finish going over how we adjust the useful life moving forward. Sorry that I ran you guys late. Thanks though for watching, and we will finish up. We'll keep working Wednesday, okay? Just one second. Let me close this so that I don't keep recording.